Well, how's it going, friends and family? My name is Amos, and this is going to be the complete opposite of my Biggest Losers video that I just uploaded. So something about me that you have to know is that I'm 35 years old. I know the face might suggest otherwise, but I'm an old fart. And my risk tolerance is really low, like well beyond my age. I have the risk tolerance to that of like a 64-year-old. And that's because I have a lot of poverty in my background. When you don't have enough to eat growing up, it kind of changes your psychology and perspective as an adult. So as an investor, it has really influenced my decision-making skills, right? Up until this year, I used to be pretty hands-off and just invested into an S&P 500 ETF in a lump sum format. Now, don't get me wrong. Honestly, I think that's a pretty valid strategy. It's coherent and it makes sense for almost 99% of the people out here. But going into 2025, I wanted to experiment a bit. I felt as if I wasn't utilizing my educational background, and I certainly wasn't sharpening my investing skill set. And that's when I decided I wanted to do things differently, and I wanted to be more active, but still disciplined. So my 2025 strategy is simple. It was to buy high quality compounders when they go on a dip, meaning when they go on a sell off of like 10, 15, 20%, from Wall Street and hedge funds being emotional and selling out of them to a proportion that's unwarranted. So as they go on that clearance, I would pick it up, scoop up shares, and then I would sell once they pass my price target. Now, the art and strategy of when to sell a stock, dude, there's no wrong answer. Up on the Patreon, I have a guide for when to sell for every specific scenario. But after I sell the stock with those gains, I would roll that capital into the next beautiful business that's on discount, that's on clearance. And I would rinse and repeat that strategy for the entirety of 2025. And dude, to be honest with you, if I had $1 million or whatever, I would just buy and hold. Be passive. I think that makes sense. Jumping in and out of stocks and trying to time the market, it's really difficult. However, through my systematic approach, the results, they were better than I expected. So my total return for my portfolio was 28.1%. Now on a good day, it went as high as 31%. I should have taken a screenshot, but whatever. From January 1st to December 26th, we're at the end of the year, 28% total return. I think that's not too bad. Considering the S&P 500, which is referred to as the market, we like to use it as a benchmark to see if we're overperforming or underperforming. If you can't beat the market, you might as well just invest into VU or another S&P 500 ETF, right? Because it would have yielded you 19%. And I think that's really respectable with a capital R. It's kind of crazy to see a 19% total return from the S&P 500, considering 2025 was pretty volatile. The stock market was really erratic at times. Do you remember in April 2025 when everything went 20, 30, 40% into the red? And to finish out the year 19% in the green, it's kind of crazy. Now, between you and me, my personal goal was to achieve at least 25%. To finish out the year at 28, maybe 27, maybe even 29%, I'm a pretty happy camper. Because previously, I usually hit around 18 to 20% my annual return. Now I think I need to set the bar a little higher and we'll aim for 30% next time around. But I will caveat that by saying for dividend payers like Realty Income Corporation, SCHD, Altria, Rexford Industrial, I do not apply this strategy. I just buy and hold for that passive income. I think when it comes to like dividend-oriented high-yield stocks, it doesn't really make sense for me to buy in and buy out. And on that note, if you want me to make a dedicated video on my strategy and investing philosophy, let me know, because I do apply a hybrid approach when it comes to the markets. I'm a financials and fundamentals kind of guy. I like to look at the data instead of the narrative and hype, but I do a little bit of speculation as well. I do look into the technical analysis and technical indicators as well to figure out when to jump in, especially the RSI and Bollinger Bands. But if you want me to elaborate, let me know. If no one cares, we'll just move on with the video. So why do I buy and sell with this short-term framework? Because to be completely transparent with you, I only have a limited amount of capital. I'm not a millionaire. I'm not even making more than like $300, $400 a month from YouTube. So, since I have a finite amount of cash on hand, I need to make strategic actions to turn that into a bigger sum by the end of the year. And so by buying high quality compounders when they're on a discount or when there's a flash deal, and then selling them when they become a little overvalued, then I can grow my capital in a systematic fashion instead of just buying and holding. I think passive investing is really good as well, but I think there are times when selling makes sense. So case in point, let's take a look at PayPal, okay? So let's say that you bought into PayPal during the pandemic. I think a lot of retail investors got introduced to the stock market in 2020 or even like 2021. Let's just go ahead and assume that you bought into them at $120 a share May 1st, 2020, and they ballooned up in valuation over the span of about roughly a year and some change, 155% into the green. Now, for some of us who did buy into PayPal, if you had just held on to your shares, look what happened subsequently, right? It just kept dropping, and then eventually you lost all of your gains. So if you're fully passive and you hold through the top and all the way down, you end up giving back everything that you made. The paper gains, they go right out the window. And so seeing examples like PayPal, it taught me the lesson that it's okay to capitalize on gains and to take profits, especially if a stock moves up in valuation too fast, too soon, and in a manner where it doesn't seem sustainable. For any investment to go 150% in about 13, 14 months, you gotta raise an eyebrow or two. Even if you have Botox all over your foreheads, you gotta be a little suspicious and repeat the mantra that it's okay to sell, to capitalize on those gains, and to take profits. And I don't wanna just pick on the PayPal investors, because if we look at Sprouts Farmers Market, this is an all-organic, natural grocery chain that operates in the US. It's probably the only true rival to Whole Foods, which is owned by Amazon. Just like PayPal, they ballooned up in valuation, and at one point they were roughly $173 a share. Now, if you didn't sell and you just kept holding, look at how those gains would have shrank day after day, week after week. And from its top, it's essentially down 53, 54%. Now, granted, if you bought into them, January 22nd at about $30 a share, you would have watched your initial investment freaking 5x, 411% into the green at one point, and then during its absolute peak, it would have gone up by 456%. But if you didn't sell, you didn't capitalize on the profits, look at what happened to the gains. 393%, 250%, and then down to 167%, which I still think is pretty awesome. But if you sold when you had 450% gains, that sounds a lot better than 167%, right? It's not just PayPal. It's not just Sprouts Farmers Market. Another example I want to show is Cava. They're basically the Mediterranean version of Chipotle. Fresh ingredients, salad bowls right in front of your face. Exact same situation. When did they IPO? They IPO'd in June 2023. And let's just go ahead and assume that you couldn't get them on the first day or the first week, but you bought into them at $47 a share. And then the following weeks, your investment went 30% into the red. Sometimes that happens with IPOs, and that's why I try not to jump in. The only IPO I regret not buying to this day is probably Reddit. But that's neither here or there. But had you just held on, you would have recovered, and then eventually you would have seen your investment go 216% into the green, at which point Cava was $150 a share. But if you didn't sell and you just held on thinking, oh, it's going to recover, what happens? Even with Cava, just like PayPal and just like Sprouts Farmers Market, it just kept dipping and dipping. And even if you sell right now, you would still have about a 22% gain, which is not bad, but it's certainly not the same as having a 209% gain. Now, selling at the right time, right at the peak, it's hard. Even I can't get it right, and I'm wrong closer to like 70% of the time. But the reason why I'm showing you these illustrations and examples is that sometimes it's okay to sell and capitalize on the profits, which is me putting the theory into practicum in 2025. But before I start showing you my biggest winners, I do want to be fair and show you that sometimes just holding on can massively reward you. Case in point, let's look at Walmart, right? This is a company that had a stock split recently, but for the longest time, Walmart, they were essentially flat because we predominantly associate them as the retail chain that sells stuff at a budget price. But then they started venturing into e-commerce and digital advertising and a whole bunch of other stuff to the point where their platform essentially rivals Amazon. In terms of the merchant marketplace and third-party sellers, had you just held on to Walmart instead of selling out of them at this tiny little peak, like say you bought into them at $48 and then you saw it finally reach that little peak and you're like, dude, I'm out of here. 9% gain, too soon. Because had you just held on, look at what would have happened, right? Even like right here, you would have been happy selling out at 116%. Had you just held on, look at it. It would have grown to 142%. So sometimes buying and holding, it makes sense. And I hate to use this as an example because this is really an outlier because it behaves in a really erratic way. But same with Palantir. This is a company that I bought as a SPAC for roughly $9.99 or something like that. And I held all the way through and I eventually sold out of them when they were like right here, I think, when they were about $40 a share. Dude, I thought I was a genius. I turned my $10 investment into $40. But had I just held on, with Palantir, look at what would have happened, right? This is a very outlier and extreme example, 1,900% into the green, but there are examples and times where that can happen. For every Palantir, there's also 10 PayPals, Sprouts Farmers Markets, and Cavas, or Crocs. If we zoom out 5 years and take a look at what happened to them, $75 a share roughly 5 years ago, bam, they hit a peak, 100% into the green, and then they dropped. What is this, 36% into the red, hit a peak, dropped, hit a peak, dropped. One of the reasons why I avoid the retail fashion industry stocks, I don't care about Nike. I do not care about Decker Brands. I do not care about Lululemon. It is way too difficult to predict when their day is over. Because trends in fashion and styles, they come and go. You cannot predict when they're going to have an economic moat that starts eroding by the day. Because whatever is cool today might not be tomorrow. Hopefully you're starting to see eye to eye with me that it's okay to sell out of a stock after 6 months, after 7 months, it's okay. At the end of the day, we all want to be long-term investors with an investing horizon that's like 20, 30 years down the road. But what I'm trying to say is that sometimes it's okay to capitalize and seize the gains. Now, having said that, let's talk about my first biggest winner of 2025, and that's going to be Huntington Ingalls. Now, my lesson learned, I'm not trying to preach to anyone else, but just for me, is that when a company has a monopoly in what they do, or they have a ridiculous economic moat, temporary setbacks and sell-offs, usually a very good time to start adding shares. Because a company like that, their product or service in question, it usually has leverage in supply and demand. So, Huntington Ingalls, ticker symbol HII. Huntington Ingalls makes our Navy and Coast Guards, submarines, carriers, and destroyers. And one thing that you have to keep in mind is that America cares a lot about our military. On paper, the United States, people will say that it's protected by the world's most expensive military. And that is kind of true, but in reality, it's protected by water. The Atlantic Ocean and the Pacific Ocean essentially separates us from our quote-unquote enemies. Now, when you think about it, defending that water is why the United States Navy is going to matter. Even in the age of AI, it's not going to make national defense obsolete. I would argue it would make it that much more important. Now, Huntington Ingalls is a company that I bought into February 6, 2025, and I spent roughly $1,700 to do so. And if we take a look at what happened year to date, So February, they were roughly, like 169, 177 a share. And since that point, I mean, look at what has happened. Now they're $345 a share, and year to date, they're 83% into the green. If we take a look at this company, this is exactly what you want to see in a dividend compounder with cheese. They grow sales, a top line. With a defense contractor, it's already predetermined. They have a backlog of contracts that keep their revenue a steady and a reliable cash flow machine. Because when it comes to building out a carrier that has 7,000 sailors in it, dude, you don't just do it in a whim. You don't just do it in a last second decision. No, you plan that 5 to 10 years in advance. So their revenue is predestined, and it's going to be growing year over year. It's already been determined. They're going to be compounding their revenue. And so when that sell-off happens because of human capital issues at the shipyard, dude, I took advantage of it and I bought a lot. I put my money where my mouth is. Now I want to ask you a question. Do you think I sold, or do you think I am still holding? Well, friends and family, when it comes to Huntington Ingalls, I am still holding, and I am a happy camper. I should have sold a while ago because they exceeded my expectations for what they can achieve in 2025. I knew this company could hit $350 a share eventually, but I didn't think it would happen in 2025. So if you take a look at your screen right now, I have 10 shares of Huntington Ingalls. My average cost basis is $169.75. My cost basis, a little under $1,700. Look at my total profit. 103% into the green after holding on to them for roughly 11 months. Dude, I freaking love the military stocks. That's why when you look at the landscape of YouTube, I might be the only guy that raves and is hyped about the military stocks like General Dynamics, Lockheed Martin, RTX, Huntington Ingalls. I think it's an industry that balances defense, but also growth at the same time. It's a good mix of the two philosophies. Now, what do I plan on doing? At this point, I think I'm just gonna ride. I know, sometimes you should sell, but in the case of Huntington Ingalls, and I think about the tensions that are happening around the world and the fact that most first world countries that are beefing up their military, one thing that I have learned about the US is that we don't like being second place in anything. Do you think we're ever going to allow our rivals to have the #1 Navy in the world? Absolutely not. So I think the capital spending and the revenue backlog for Huntington Ingalls is only going to get bigger going forward, which means their stock price should get bigger and bigger in a perfect world. Now, obviously, they can go on a massive sell-off and go 169 a share again, but if that happens, I guess I'll buy more shares. And if you're contemplating whether or not you want to continue watching the video, there's actually a military stock that I'm going to talk about here in a little bit that I think is a really good deal right now. I think they're still undervalued. They have not ballooned up in valuation like Huntington Ingalls. But before we get to that point, same framework, different result. Here's the next stock. It's UnitedHealth. The reason why I say it looks different from Huntington Ingalls is that they have not made their full recovery yet. I think eventually they will reach $450 a share, even $550 a share. It's only a matter of time. When will that happen? I don't exactly know. Based on my financial modeling and forecast, I think roughly 2.5 to 3 years from now, they should be $600 a share. But obviously, no one can predict the future. So why did I buy into UnitedHealth? When you think about it, it's the biggest health insurance conglomerate in the US, and they even provide health services through their own network of hospitals and doctors. In my opinion, when they went on this massive sell-off, they were $600 a share, and then they went on this massive sell-off, I think it was overblown. I'm being serious right now. Wall Street, they put a death sentence on UnitedHealth because of the scandals, the fear of regulatory changes, and of course, the leadership transition. I'm not gonna lie to you. Those factors, they did weigh into my decision-making process, but you know what? That for me was an easy yes. No, I did not buy into them after their initial dip at 425, or even when they continued to dip to 380. No, I didn't buy into them, and I would be lying to you if I said that I bought into them right here when they were 274 a share in May. No. They were on my watch list and I was monitoring them carefully because at this point, I didn't know if it was going to be a falling knife to catch them right here or to catch them right there. But to see that dead cat bounce and slight recovery, that's when I decided, okay, now they have a line of support. But what happened to them in the following weeks and months? They went on another massive sell-off. And that's when I pulled the trigger. Why? Because UnitedHealth, it's not some failing startup that's burning through cash. UnitedHealth is literally the backbone of the US healthcare system. And even if regulatory changes come, it's not going to disappear overnight. Why did I buy into a company that had so much negativity surrounding it? Because if you take a look at your screen right now, their gross sales, the top line, it's growing year after year. It's so predictable and it's reliable to the point where you don't have to worry. Like, are they going to grow? Yes, they're going to grow. And what about their bottom line? Yes, it did take a pretty big hit in 2024 because of the Medicare changes and more senior citizens seeking out services than they had anticipated. But look at the recovery, right? They're adjusting their sales and now they're back on the path of good profitability, right? So year over year, they bounced back at 25% for their profits per share. $18.98 of free cash flow per share. Now I hear you. Going in this trend from 27 to 18, not phenomenal. But to stabilize at 18 and now they're making a recovery, I like. If that free cash flow dropped to like $1 per share or even went into the negative, I probably would not have bought into them. And as a dividend growth investor, I mean, their dividend profile at the time, I think it was like a 3.5% dividend yield when I decided to buy into them, and the dividend growth rate of being 6.7%, this was almost too easy. The fundamentals were screaming buy when the headlines were screaming run. A lot of the folks out here were like, dude, UnitedHealth is done. They're cooked. But the numbers, financials, and fundamentals, they were all still excellent. So ultimately, I did buy into them. When did I buy into them? I first pulled the trigger July 17, 2025. I bought $1,700 worth that day, and then another $1,100 and another $580. And then I dollar cost averaged on July 24th. I spent $1,100 on UnitedHealth, and then I did it again on July 29th and July 30th. I put roughly, $4,300 into UnitedHealth in the span of 48 hours. So taking a look at what happened in July, this is when they went on that massive sell-off where I was like, I can't watch them on the sidelines anymore. Now, I really wish I bought them on August the 1st, but I think I got pretty close. I started buying into them when they were around right here, like $266, $280 a share. In the grand scheme of things, from $266 to $328, I'm a happy camper. I like it. So my question to you is, do you think I am still holding, or do you think after this small recovery, I sold out of UnitedHealth? I'll give you some time so you can respond. I think my answer is going to surprise you because in the beginning of the video, I went on this huge rant and articulating my argument for why it's okay to sell sometimes. But again, I did not sell yet because I still think they have a lot more room to grow. So right now I have 37 shares of UnitedHealth, average cost basis $271 a share. I'm in the green by roughly 21.4%. I think that's chump change. I still think it can go up 50, 80, 90% into the green in a matter of a year, year and a half. So to sell them after a 21% gain, not my cup of tea. I'm willing to wait patiently, because the financials and fundamentals are sound, and I'm like, they'll be okay. And the best part is, while I wait for them to go back up to $450 or $500 a share, I'm getting dividends. But then again, the video's about my biggest winners this year, not necessarily everything that I sold for a gain. So it's coming up soon, I promise. Now, having said that, let's move on to the next company and see how the same strategy played out. And that's going to be Lockheed Martin. This is a company that's been on my watch list for 7 years. And I'm actually really happy that I got to pull the trigger and buy into them this year. Now, just in case you don't know who Lockheed Martin is, the United States Air Force right now, they're actively replacing their F-16 fleet with the F-35s. Now, just take a wild guess. Who makes the F-35 fighter jet planes? Dude, you're so freaking smart. Look at you. Oh my goodness. Yes, it is Lockheed Martin. But to show you what I'm saying, in the past 5 years, I never really got the chance to buy into them when they were on clearance. Because even when they went on their small little dips, they were still slightly overvalued. However, back in July, they were roughly $488. One might even argue $500 a share. But after they reported their Q2 earnings, They went on a sell-off for a good reason because it was really hideous. I mean, they went from almost $500 a share down to $410 a share. It was probably one of the worst earnings that I have seen in 2025, and I am not exaggerating because they took a $1.6 billion loss on a classified project, and it made their bottom line all wonky. To take that big of a hit, it's pretty bad. And the worst part is, because it's classified due to military sensitive information, the investors, we didn't know what's happening. And to be honest with you, I think the sell-off was warranted. It made a lot of sense. But what happened afterwards? After they sold off, they just made their inevitable rebound and they went up to roughly $514 a share. Because similar investing thesis to Huntington Ingalls, but this time it's for the United States Air Force. When you think about Lockheed Martin, they're best in class at what they do. And they're crucial for our military because of their jets, helicopters, and their missiles. So during their little sell-off in July 22nd, as you can see, I went in pretty big. No, I'm not one of these whales walking around with like $20 million to just throw into companies. For me, this is a lot of money. Now, as a reminder, I'm living on minimum wage. So for me to throw this type of money into Lockheed Martin, you best believe that my conviction in them was pretty darn high. And so having seen their recovery play out, what do you think I did? Do you think I sold out of them or do you think I'm still holding? I think the answer is going to surprise you. Again, just like UnitedHealth, I think this is a company that even at $488, they have not reached their full potential. This is a company that can easily hit $600, $700 a share in the coming years. If we scroll down and I show you my position, 12 shares of Lockheed Martin. They're really expensive. I wish I could have 20. I wish I could have 50 shares, but 12 shares, I think it's a modest amount. And that set me back $5,000. My average cost basis per share is $417. No, I did not calculate and cash them at their absolute bottom of $410. $417. I'll take it though. And since I bought into them in July, I'm up in the green 17% or $853. Now, had I have just sold out of them when they reached their recovery peak right here in October at $511, I think my total return would have been like 25% into the green. Would have been good. But I didn't know that they were going to go on a sell-off in November and leading into December. But since then, they've recovered, so whatever. For Lockheed Martin, I'm just going to continue holding on because to sell out of them after a 17% gain, I'm leaving money on the table. I will capitalize on the profits eventually, but right now is not the time for me.